So let's have a look at another word that is given to this conflict that is caused, and we call it suboptimization. That is, the decisions made by the individual divisions are not optimal with respect to the decisions that corporate head office would have made if they were making the decision on behalf of the division. Okay, but they decentralized authority to the division to make this decision. You understand that, don't you? Knowledge transfer costs. That's why they did that. All right, now that they have done that, we've got to try and use a measure to get them to make the right decision. So does return on investment help this? Sometimes yes, sometimes no. Let's have a look at this example. We've got corporate cost of capital of 10%. We have an investment opportunity. You invest $10 and you'll earn $1.10 per year. So let's go through unit A, C, and D. Now you know their current return on investment is 20%, 10%, 5%. And so let's go to unit A, C, and D, shall we? Mr. Unit A, would you like to invest in this project? Unit A says, well, what's the internal rate of return? At 11%. Let me have a look. I'm currently getting 20%. You're offering me 11%? No way. Go away. Okay, so Unit A saying, no way. Why are they saying that? Because their return on investment, if they do invest, will go from 20%, it will go down to 19.3%. What about Unit C and D? Mr. Unit C, would you like to invest in this project? Unit C said, wow, what is the return? It's 11%. Well, we're currently earning 10%. Yes, let's do that because that will improve our 10% overall return on investment to 10.08%. Hey, I want anything that's above 10%. It's going to increase my bonus. Same, Unit D will go from 5% down to up to 5.76%. Yes. So Unit A is going to make a wrong decision from the point of view of corporate value creation, and that's going to be suboptimal. Whereas Unit C and Unit D will make a decision that is congruent with value creation from the point of view of corporate head office. Let's have a look at another example, shall we? Let's go to another example. We got an same investment and it is $1.10 per year. But now the difference is the corporate cost of capital is not 10%, it is 15%. So Unit A, you offer them this investment, and of course they will say, no, we're not going to invest. Now, from a corporate point of view, we should not invest in this investment. Why? Because the 15% will go down. It will go down because you're investing in a project that's going to return you less than 15%. What about C? Well, C is currently earning 10%. Of course, they're going to like this 11% return. That's going to improve their value to 10.08%. So they're going to say, yes, let's invest. And D is going to say, yes, let's invest, because their 5% is going to go up to 5.76%. But from the corporate point of view, this is going to be wrong here and here. This decision to invest is wrong because this project should not see the sight of day from day one. It should not be invested in at all because it is less than the corporate cost of capital. So you can see how this conflict between what divisions see as a good investment and what corporate sees as a good investment, it shows out when a project has an earning, a return that is sort of in between the corporate cost of capital and the division's current return on investment. And you can see that A makes a good decision here, that's right, but previously they still did not invest. Even when the corporate cost of capital was 10%, they were wrong. They still did not invest. They were wrong. Now they are right, because now the corporate cost of capital is 15%. In other words, this is congruent with the value creation from the corporate point of view. This decision by C and D is incongruent. In other words, it is suboptimal from the point of value creation at the corporate level. So we can overcome these problems with return on investment in the following way. We move away from the percentage benchmarks that are set by return on investment and comparing that with the internal rate of return of a project. What we do instead is we create dollar benchmarks. That is, we have a kind of hurdle, and this hurdle is not in terms of a percentage, it's in terms of a dollar value, and anything over that dollar value becomes a residual income. So let's have a look at what we are doing here. Residual income makes performance targets uniform, and divisions will invest if the internal rate of return of a project is greater than the capital charge, which could be set equal to the corporate cost of capital. So if the capital charge is 10% and the investment is going to earn $1.10 per year, so therefore this investment is going to earn a residual income of 10 cents per year, because the capital charge is 10% of $10. So the capital charge is going to be $1. It is earning $1.10, right? So $1.10 minus the capital charge equals, yes, you got it, 10 cents. There you are, my fancy writing here. I think it works. There we go. All right. So we should see all divisions making the decision to invest, because that 10 cents will go to the division's bottom line. And let's have a look. Now we are looking at division A, C, and D from the point of view of their profit before tax, their investment base, and residual income. So the residual income is based on their profit less their current asset charge less their fixed asset charge. Okay, 4% of 60, 10% of 70. Remember, we went through that earlier. Okay, so it's $9.4, and that's taken off $25.01 here, minus 9.4. Then we're left with a residual income of $15.7. So is that higher than the current residual income of Unit A? Yes, it is. So Unit A is going to say, yes, I'll invest in that. Unit C goes from $5.70 to $5.80. The capital charge is calculated down here. Yes, they're going to invest too. Unit D goes from 1.6 now to 1.5. Do they like that? Of course they do. Okay, and of course there's a calculation there, the capital charge that's taken off $4.90. And so yes, they're going to invest. So now all divisions are making the same decision for the same type of investment of $10 to earn $1.10 per year. And this decision to invest, yes, yes, and yes, number one, is congruent. That means all divisions are making the same decision, and it is congruent with head office, their value creation at the head office level, which is based on the capital charge. Head office, if they did not delegate, if they did not decentralize, and they made the decision, they would have said, yes, Now they delegate, and now they make the divisions accountable to residual income. And guess what? The divisions are saying yes, yes, yes. And so now we have optimization because the decisions made by the divisional managers is exactly the same had decentralization not taken place. And so that's what we mean by optimizing the use of your delegation of authority to divisional managers. Okay, if you can have some measure that forces them to make the same decision that you would make in the scenario when you did not delegate that authority. So there we have a great example of how residual income triumphs over return on investment as an accountability device to make divisional managers, no matter what their performance, to make the same decision that is consistent with the head office. Okay, let's have a look at the next section. We have a few little items to make clear about the summary of residual income. Residual income allows for the use of different interest charges for different types of assets. Notice in the example, we had a 4% charge for current assets and a 10% charge for fixed assets. Notice that's different. Return on equity measures induce managers to use debt financing. Now, because residual income does not base its calculations on return on equity, we can avoid this problem where managers use debt financing. Why would you want to use debt financing? Because that enables you to inflate the return on equity, because as the debt gets large, guess what? Equity gets smaller, right? Debt plus equity equals total assets. You got that, haven't you? All right, so we're trying to avoid that. Finally, return on asset measures create incentives for managers to lease assets. Return on investment measures create incentives for managers to lease assets, that is, take assets off the books. So the asset base, or the denominator, becomes less, and guess what? Your return on investment gets larger and larger. Why? You've got higher numerator and a smaller denominator. Everything else being equal, your return on investment looks larger. So keep in mind, these are some little issues that need to be taken care of, either in the contract terms or in the policy of corporate head office, that it dictates to the divisional offices on how they use their accounting to create various measures of performance against which benchmarks are compared, against which residual income is calculated and bonuses are paid. So we can think about other issues, for example, the fixed asset portion. Both residual income and return on investment get better merely through the passage of time. Why? Because as you have a capital charge, the net book value of your assets goes down because it gets transferred into income, and the residual income goes up. Return on investment goes up. Isn't that great, huh? Both return on investment and residual income are usually overstated if the business unit includes a relatively large number of older assets. See, as the assets get older, their book value base gets smaller and smaller and smaller and smaller and smaller. And guess what? When it comes to replace the assets, do you think you want to replace sooner or later? No, you want to replace these assets later. You don't want to replace them at all, right? Because as soon as you replace them, suddenly, the asset base doubles overnight, especially if it's 10 years before replacement, okay? Because the machine is nearly written off then suddenly you replace it with a brand new machine with inflation and everything. Suddenly, wow, the new book value could be 2, 3, 4 times the amount of that written down value. All right, so managers are reluctant to replace assets. For this point, managers are reluctant to replace assets when residual income is used. Managers are reluctant to replace assets, especially when return on investment is used on its own. Other issues we've got, and I've mentioned some of these already, misleading performance signals. Strategic business unit managers are encouraged to retain assets beyond their optimal life and not to invest in new assets. As I've just made very, very clear to you, as you keep the old assets, the asset base, the denominator on return on investment gets smaller and smaller and smaller and smaller. So your performance looks better and better and better and better. All right, more bonus, more money. Yes, yes, yes. Okay. Corporate managers are induced to over-allocate resources to business units with older assets. So they want to squeeze the cash cow and feed the dog. Why? Because the business units with older assets, they appear to be having larger return on investment. And so then they can justify new initiatives. They can justify giving more bonus. They can justify hiring more staff. Why? Because their return on investment is better. Can you see that? So corporate managers are induced, because they don't know much more, because of knowledge transfer costs. They don't know everything. A division is far away, and the division's showing really good returns. It's showing good returns because the assets are getting older and older and older and older. And so basically more money is ploughed into those divisions. But the divisions with newer assets, the denominator is larger. So the return on investment is small. And even though these newer cash cow generating divisions are likely to be the future value creation activities at the enterprise, it's harder for them to justify their existence because their return on investment is so low because they have a newer stock of assets. So keep that in mind. When you have divisions with different age stock of assets, it's going to be very hard to compare return on investment with return on asset. It's going to be hard to compare return on investment across these two divisions. And so that's what we mean with this second point here. Squeeze the cash cow and feed that dog. So, combined with the suboptimization issues discussed above, managers of units with older assets and hence higher return on investment are likely to be more reluctant to invest in desirable projects with an internal rate of return higher than the corporate cost of capital. Okay. And next, the gross book value is another measure, but however, in periods of inflation, old assets valued at gross book value are still expressed at lower values than new assets, so the return on investment is still overstated. And so the point here, gross book value, in other words, you're not writing down the asset from depreciation, you're still retaining the gross book value of the asset, and you're thinking, okay, we can overcome this, right? No, because still newer divisions have to pay more for machinery, for robotics, for buildings. Why? Because inflation goes up over time and things get more expensive over time. And so even when you use gross book value, you can still have unfair comparisons between divisions because one division has an older stock of assets, a newer division has a newer stock of assets, even without amortization and depreciation going on in the denominator. Okay, so that's the big point here. We could use gross book value, but still, it's still going to be hard to compare divisions on return on investment. Again, that is argument for using residual income and not return on investment. So what I've done in this section is illustrated to you what we mean by return on investment and what we mean by residual income. And to show, we want to illustrate that, okay, if we use return on investment, it's likely that we're going to have suboptimization. And suboptimization occurs when any division makes a decision that is not congruent with the head office value creation. And at the end of the day, you want to make value creation decisions at the divisional level. That's where the operations occur, right? That are consistent with what the head office sees as creating value for the overall organization. That's what we need to do. And because head office has delegated the division to do it on the head office's behalf, why? Knowledge transfer costs. Okay, we need to have the right signal that makes that divisional manager accountable to make the right value creating decisions at the operations level. And the best signal here is when we use accounting numbers. Remember, we're using a system that's cheap. Best signal here is not return on investment. It's more likely to be residual income. So we're actually using a signal that is dollar based and not percentage based. It's a signal that is based on the current additive value that a project will add to the firm's profits, rather than comparing a current opportunity return with the current return percentage of all the other current stock of assets in place in the division, which is return on investment. Okay, we don't want to do that, because then the division is not going to make a suboptimal decision all the time. Sometimes they will, but sometimes they won't, as we showed. So take that away. Accounting is used because it's cheap. The system is there. Understand that we've got a cheap system. It's a robust system because it's audited, it's verifiable, it's precise, it's reliable. So it's a good system from that point of view. But it can be abused and can lead to suboptimization if you don't understand the benefits and disadvantages of using return on investment. However, there's light at the end of the tunnel. Residual income is one way of overcoming the disadvantages of return on investment. Catch you in the next session, and thank you for watching. Bye for now.